that illustrates the value of properly calculating the need for life insurance in a very powerful way. Early in my career, I was working with a physician in Southern California who was very busy and didn't give me any time to help him determine the amount of life insurance that was appropriate for his family. Rather, he asked me to simply sell him a $500,000 policy. I complied with his request, only to read several months later that he had been killed by a hit-and-run driver while changing the tire on the side of the freeway. I took great pride in being able to deliver the much-needed cash to the family, only to be shocked to learn that the doctor had 9 children, 3 of whom were in college at the time. I distinctly remember sitting in a room with his wife and all of his children when they collectively asked me, "Is this all there is?" I felt badly that I hadn't found some way to break through to the man and convince him to approach the process the proper way. I vowed never again to shortcut the process and to always calculate the real need for life insurance. I never have shortcut the process since, and you shouldn't either. There are no do-overs with life insurance. There's nothing more important than buying the right amount of coverage, and you need to get it right the first time. So after you've figured out how much you need, you're now ready to focus on what kind to buy. There are 2 fundamental considerations that go into answering this question. First, how long will you need the insurance? And second, how much money do you have in your budget for this expense? The how long you need it question will help you decide if you want term insurance or permanent insurance. Term insurance lasts for a specified period of time, say 5 years or 10, 20, or maybe even 30 years. If your only need is for funds to pay off a 20-year mortgage at your death, a 20-year term policy would probably be the answer for you. Or if you're concerned about providing funds to take care of your aging parents in their later years, a 5 or 10-year term policy might do the job. The shorter the period of time the policy lasts, the lower the premium. But once the term period is over, you'll have to pay a considerably higher price to maintain it if you want to do so. And you may well have to take another insurance physical to qualify all over again. That means your health must still be good and that you haven't taken up piloting, skydiving, or vehicle racing. Declining health or a dangerous job or hobby can significantly increase the cost of insurance and sometimes can make coverage unaffordable or even unavailable. That leads me to the second kind of insurance, permanent insurance. Permanent insurance is what the name implies. It's with you for life, no matter how old you are when you die. The premiums are projected to remain level over your lifetime, and in some cases can be designed to stop at retirement while your coverage remains in force for life. Permanent policies build a cash surrender value that is available if needed in the event of emergencies, opportunities, or college for the kids. Of course, these benefits come with a price. The initial premium for permanent insurance is 3 to 10 times higher than it is for an equivalent